Hello, everyone, and welcome to the Weekly Watch. I'm your host, John Briggs. Events in the UK continue to dominate markets, and this week I'll be joined by our head of UK rate strategy, Imogen Bachra. Before I get to that, I want to hit on the US as well, where we had yet another CPI report that was stronger than expected, putting to bed yet another attempt at the markets to argue the Fed is close to a pivot point. Listeners know this is something we've been cautioning about for quite some time, that throughout the rest of the year, we worried that investors would be trying to find any reason to think the Fed would be less aggressive or turn more optimistic on the Fed, and that a pivot was coming. But our warning has been not to be caught up in that. Again, we find ourselves in the same place. There's been talk of a pivot, hope for optimism on that front, to be only erased by a stronger than expected U.S. inflation report. So, I mean, it's true that we don't think that the Fed is going to continue to hike aggressively at 75 basis point clips, although we do think that is the case in November and now possibly December, depending on future inflation data. But I do recognize at some point the Fed can slow and let restrictive policy do its work with monetary policy lags and all that. But the thing is, we're just not there yet. And even when we get there, I actually do believe the Fed when they say that they're going to need tight policy for some time. So any speculation about easing, which is kind of the next step of any said pivot, is beyond premature at this point. We're at least months, maybe quarters away from having that discussion. So let's get inflation to stop surprising to the upside for one before we start entertaining these ideas. And that feeds into kind of ongoing caution to some extent around risk assets. So that out of the way, let me bring in Imogen to talk about, obviously where things have been most volatile and continue to be most volatile. Imogen, thanks for joining us. And I do know that by the time this podcast is released, a day after it's recorded, much is probably going to have changed. So as best as you can, let's try to answer these questions. So first, even today, there's been a lot of newspaper headlines about the fiscal side of things, which did kick off a lot of this turbulence. So where do we stand now? What is going on with fiscal policy? Where are we going forward now?
Well, yeah, just to repeat your caveat, John, that things are moving rapidly in the UK, particularly on the fiscal front. So I expect there to be a lot of headlines on this, over the next couple of days and probably really only over the next couple of weeks, because the latest is that Kwasi Kwarteng, the Chancellor, is suggesting that we won't hear on any updates to policy until the official mini budget, which is set for the 31st of October. Now, gilt markets got a bit of a respite today from their continued sell-off on reports that the government would be U-turning on some policies. Now, there's a huge amount of uncertainty here around what policies and to what extent they will be U-turning, but nonetheless, markets took a little bit of comfort in that. Just a word of caution, I suppose, from me, from a markets perspective, is that, the bulk of the additional borrowing, particularly for this fiscal year that was announced, of that 72 billion that was announced back in the mini budget a couple of weeks ago, most of that is the energy price cap. And although mainstream media and financial journalism has focused on these unfunded tax cuts, which is what forced the government's hand a couple of weeks ago to that U-turn on the top rate of tax policy, actually they make up a very small proportion of the additional borrowing. So from a markets perspective, although what might be considered a bit more fiscal responsibility seems to be comforting for gilt yields, from a flows perspective, I'm not sure it really changes the overall picture that much. But like I say, there's a huge amount of uncertainty still, a lot of different press reports flying around, and we may not have more clarity on this until the government formally announces in the budget that comes accompanied with the OBR forecasts on the 31st of October.
Okay, I'm going to come back to a little bit of what you said about the market view and the numbers there as far as gilt forecasts go. But before that, if we switch to the Bank of England, it's pretty clear that they want to be done with purchases this week. So and again, lots of newspaper reports that they may not, and all that stuff. Where do we actually stand as far as that?
It's been a lot of back and forth in headlines this week, but Bailey and the Bank of England, Governor Bailey and the Bank of England have been pretty headstrong in suggesting that these temporary purchases will end tomorrow. So we're recording this on Thursday, so tomorrow being Friday. And at the moment, I don't really see a reason why they would have to roll back on that. The market seemed to take it fairly well in its stride, I think. When Bailey announced after the close that they would be definitely not continuing these purchases beyond Friday. Although there was then a little bit of rollback in an FT article, the market actually only opened 8 basis points weaker, which in this environment really isn't that weak at all, and actually managed to recover most of that during the day. And obviously now sentiment has been even further supported by news today around the U-turn on fiscal policy. So I don't think there's anything in market moves over the last couple of days that would make the governor question his decision to extend these buybacks. And as we know, they've been buying a considerable amount more over the last couple of days and rejecting a much smaller proportion of the offers that they've been receiving than they did in the first week. Over the last couple of days, they've now, well, in total, they've now bought nearly 18 billion across the nominals and linkers, but the vast majority of that has been over the last couple of days. And in fact, 7 billion of that is linkers, which they only started buying on Tuesday. So that gives you an idea of the kind of scale of support that we've seen just this week, really, versus the total buying period.
All right. So now turning to kind of the gilt market itself, and I'll be honest, I've been a little bit on the road, so I'm checking my Bloomberg on my phone, and I see headlines of 1.2 dividend this cut, 1.2 of that, and I'm encouraged by markets taking this in a good way, but it seems kind of small to get to be now talking about structurally lower gilt yields. I mean, you hinted at this before. I mean, you agreement on that?
Yeah. To be honest, the trigger for this significant shift higher in yields and the volatility that we've seen really is about the mini budget that we had 2 weeks ago, in which the government announced a significant increase in borrowing needs, which were all going to be, all this additional tax cuts were going to be funded via borrowing on the market. And that came higher than expected. And of course, there were other bearish influences that didn't help, like, for example, QT that was meant to take place a couple of weeks ago, and the fact that they were capping energy prices, which probably, at the margin raises your growth and inflation forecast over the medium term, and therefore raises your bank rate profile. But the real trigger was about how this additional fiscal stimulus was going to be funded, which was via more gilts on the market, essentially. And no matter what the government do really in terms of U-turns, a lot of the suggestion around what tax cuts they may well U-turn on are a really small proportion of that additional borrowing. Like I said before, the vast majority is to do with the energy price cap, and there's no suggestion in the press so far that they will be rolling back on that, and nor should they. Clearly something needed to be done to mitigate that cost of living crisis on the consumer. And the same goes for the Bank of England. There's lots of discussion about, even if they end the temporary buybacks on Friday, do they push back QT, beyond the planned 31st of August date? That obviously coincides with when we're supposed to be getting the mini budget, the updated remit, and the OBR's projections. There's a Bank of England meeting on the 3rd of November, so perhaps they could at least delay a decision on then till after that or till at that meeting. But really, these small delays or potentially small U-turns in the government's fiscal policy don't change the overall picture for net supply. There's a regime shift coming on the supply side, really, that will involve a significant amount more gilts coming to the market, not just in this fiscal year, but in the years ahead as well. And markets are right to kind of be repricing quite significantly higher, we think, to reflect that changing macro backdrop. And the only thing I would add to that is that, I think the government have backed themselves a little bit into a corner now with all of these press reports today, because markets have adjusted quite quickly and priced in this U-turn now. And, I think that the risks here are that any potential U-turn on fiscal policy underwhelms the significant rally that we've seen today. So I still think that the direction of travel is towards higher gilt yields from here. And as a first stop, I'd be looking for 10-year gilts to get at least back to 4.5 and then beyond there over the next couple of months.
Yeah, and I think that's right, but it just, for me, it's about hoping that as we get there, we don't have to get there all at once. If something turns around or changes in the next few days, and Ross and I talked about this in the last time I recorded with him. It's like the speed of the issue was or the speed of the move was as much of the issue as like just the actual level, because the levels seem to be appropriate, or as you say, like at least around 4.5, but getting there all at once seems to be the problem. So, fingers crossed that as we get through the weekend and head towards that budget, that we can at least maybe calm markets down. We started to look at it a little bit when you thought 10-year gilt yields ranges of only 15 basis points was actually calm. It tells you what kind of markets we're dealing with, but we'll see, I guess, next week. Imogen, thank you so much. You're going to be very busy, so I appreciate you taking the time to join us. And for everyone else, thank you for joining us for this episode of the Weekly Watch. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available. Hit the like button so it's easier for others to find it. Thank you. Good luck.